Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing GE stock by analyzing their financial statements and dissecting their financial ratios, so we can determine if it's a buy or a sell. GE operates through the following segments: aviation, healthcare, power, renewable energy, digital industry, additive manufacturing, venture capital, and finance. GE is the 21st largest company in the United States. 2 employees of GE have been awarded the Nobel Prize. Let's get started with the model. This is a large cap company, market cap $95 billion. They're trading at $10.88 a share and have 8.8 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the future free cash flows and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So the company has positive free cash flow in 3 of the 4 years. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they have negative net income in 3 of the 4 years. Their revenue doesn't look so great. It's $120 billion in 2017, then it drops to $83 billion in the trailing 12 months. This is the company's income statement, and you can see the top line is the revenue, the sales for the company, then the cost of revenue. Below that is their gross profit, which is the difference between revenue and cost of revenue. So they do have positive gross profit each year. They do have pretty high operating expenses. But it is good to see they have positive operating income every year. They just have so much expenses. They have a lot of debt, so they have a lot of interest payments on the debt, which is here. They also have a lot of other income and expenses, and most of that is through impairments. They also have to pay taxes, so their net income doesn't look so great. It's negative in 3 of the 4 years. This is a breakdown by segment. Their aviation segment is the largest at $33 billion. Then healthcare at $19 billion, then power at $18 billion, and renewable energy at $15 billion. In terms of profit, aviation is the most profitable at $6.8 billion, healthcare at $3.9 billion, and renewable energy and capital lose money. This is the company statement of cash flows, and when you want to invest or value a company, you should look at operating cash flow. That's how much money the company generates through its operational business. So they do have positive operating cash flow each year, which is a good sign if you want to invest in this company. They do have a ton in CapEx, $4 to $8 billion a year. But they do have positive free cash flow in 3 of the 4 years. Only in 2018 it's negative. They do fund a lot of their business on debt. In 2017, they issued $15 billion, then $3 billion, then $2.2 billion, then $15 billion. But they paid more in debt than they issued. They paid $25 billion, $21 billion, $17 billion, and $28 billion. It is a good sign to see that they are paying down their debt. Let's look at a capital structure. They have $94 billion of debt, but only $9.1 billion of net debt. Net debt is total debt minus cash on the balance sheet. They could almost pay off their entire debt balance with the cash on their balance sheet. They have $30 billion of equity. The interest rate they pay in their debt is 5.5%, and the cost of debt is 4.7%. To get cost of debt, it's interest rate times 1 minus the effective tax rate. And they're pretty leveraged. 76% of that capital structure is debt, so 24% is equity. The cost of equity is 10.3%. And their beta is a little over 1, so the stock moves with the market. Their WACC is 6.03%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $37 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $41 billion. We divide that by 8.8 billion shares. And we get a calculated stock price of $4.73. They're trading at $10.88, so they're trading at a 130% premium. It's a sell according to the model. Simply Wall Street values them at $11.26, so they're saying the stock is undervalued. So you can see the stock was trading over $30 a few years ago, but it's been on a steady decline. So it looks like it could be a really good value if you're bullish on this company. But based off of their revenue decline and their free cash flows, it just doesn't look like a good value, at least according to my model. Their dividend is 0.37%, and they pay 1 cent per share per quarter. To calculate dividend yield, it's annual dividend over stock price. So as the stock price comes down, the dividend yield goes up. And when the stock price goes up, the dividend yield goes down. If you invested $10,000 into this company 10 years ago and you reinvested the dividends back into the company, you'd have $8,900 today. If you did not reinvest the dividends back into the company, you'd have $10,500 today. That just shows you how much GE has been lagging the market. Let's look at their financial ratios. The average PE in the market is 12.6, the median is 14.3. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 28.7, so they're doing much worse than the median and average. The average price to sales ratio is 6.1, the median is 2.2. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 1.1, so they're doing much better than the median and average. The average price to book is 4.7, the median is 2.3. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They're at 3.2, so they're between the median and average. Equity is assets minus liabilities in the balance sheet. Their tangible equity is negative $9 billion, which means they have a lot of intangible assets on their balance sheet. The average interest coverage ratio is 12.7, the median is 3.8. Interest coverage ratio is EBIT over interest expense. They're only at 0.1, so they cannot cover their interest payments with their operating income. EBIT is earnings before interest and taxes. The average ROE is 10%, the median is 11%. ROE is net income over equity. They're at 11%, so they're at the median. Average current ratio is 1.9, the median is 1.3. Current ratio is current assets over current liabilities. They're at 1.8, so they can cover their current liabilities with their current assets. Their current assets are $85 billion of cash, $27 billion of receivables, $14 billion of inventory, and $13 billion of assets held for sale. They seem to be well capitalized. Their free cash flow in the last 12 months was $2.6 billion, and they have $63 billion of working capital. Working capital is current assets minus current liabilities. The best way to look at ratios to compare them to similar companies, I've done videos on Altra, Graco, Honeywell, 3M, and Savaria, all in the same industry as GE. And if GE has a number in green, they're better than the average. If they have a number in red, they're worse than the average. They are better in all the price multiples, PE, price to sales, and price to book. Their current ratio is a little lower than average. ROE is a little lower than average. They're much higher in debt than the average. And their market cap is bigger than average at $95 billion. Average is $60 billion. Although they are smaller than Honeywell and 3M. They pay the lowest dividend of all the companies in this industry. So to summarize, I have them trading at a 130% premium because it seems like their sales are struggling. Plus they have that huge pension plan to deal with. And their ratios look okay. Let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.